So let's go ahead and move forward on the markets. So where are we? Well, let's first talk about the current GDP. GDP is a real indicator of any kind of economic activity. So when the GDP goes down, it's reflective of we've got a problem in the economy. When the GDP goes up, it shows that, hey, the economy is getting more healthy. So what we found this week is that the GDP actually went up from last week from a 31.7 estimate to a 32 estimate. Now, that may not seem like much, but every point makes a huge difference in dollars. So the GDP is going in the right direction, and it looks like we're going to have a pretty solid quarter for Q3. You've seen this chart before. We show it really every time we have the market report because it gives you an idea from the price earnings ratio. Where does the market stand? How's the health of the market? And the price earnings ratio is currently moving up, and it has been, quite frankly, over the last few months. But we now topped over 29. So we're at 29.5. What does that mean? It means that a lot of the market's a bit overvalued. I would also say, and look at things this way, as we were looking at the overall market, the reality is the market is pushing higher, but is every sector moving higher? And at the end of the day, the answer is no. You can tell that the tech stocks are moving high. Anything that's related to doing things at home, especially business, is actually moving upward. More of your brick and mortar type companies are having a much tougher time. So there is a huge dichotomy between the real successful companies out there and the ones that are just having a bit of a hard time at this stage. One of the reasons it's so important to get the economy moving forward and opening up again. So that being said, let's take a look at some of the other things that we've got going here with the markets. And I'm going to focus a little bit on the dividend stocks out there. A lot of people invest for the dividends, and they're wondering why, some parts of their portfolio are up while other parts of the portfolio are down. Well, when you're looking at this, it's really kind of interesting because the high dividend sectors, which is the gold bars, are actually not performing all that well. As you can see, the high dividend index is actually down about 19% compared to the S&P 500. Now, keep in mind also, high dividend stocks are going to run really 4, 5, and 6% dividends on them, whereas your typical S&P is going to have an average of 2% dividends. But right now, the dividend stocks, the high yield dividends, are just not performing well. And the interesting thing is that they normally do well in recessions. So there's a bit of a dichotomy going on right there. The lower yielding dividend stocks tend to be a lot more volatile, kind of like your technology sector and discretionary. So it's just interesting. This is why it's so important to be a tactical manager, to be able to move in and out of different sectors to try to capitalize on that which is moving forward. Now, none of the money managers are going to be perfect, but they're certainly working well to gain as much as they can in the safest manner possible. So that's your high dividend. Now, what could put pressure on the markets? Well, the reality is all you have to do is look at the newspaper. So the media's got a whirlwind of different ideas that could create a downturn on the market. And certainly any one of these can create havoc or actually add to the combination of events that will drop the market. But the reality is, when you ask the question, should investors be concerned about a market sell-off? Well, the answer is yes and no. So think of it this way. After 5 months of relatively steady advances, the U.S. equities have experienced their first sign of kind of a hiccup. And we'll talk about where we are in the market today. But when you think about the overall concerns that we have in the market, right now there's a little bit more skepticism. Why? Because there's a question as to whether we're actually going to get another stimulus package before the election. We're not sure. The two sides don't seem to be coming together as well as they should for the people. And there is signs of slowing progress in the labor markets. And if you think about it, the longer we stay closed, the more likely businesses are going to close for good, and that's shifting the labor numbers. So again, very important to get the economy going, but it certainly has shifted the sentiment out there. Now, if you look at this chart, it shows you the bear market bottoms from 1970 to 2020, and the number of pullbacks within the first year of the recovery. And you can see the 5 to 10% pullbacks are quite frequent when it comes to the first year of a bull recovery. Now, there are times where you have a greater than 10%. And as you look at this chart, it's happened 4 times during different recoveries. So the question is, should investors be concerned about market sell-off? Well, like I said, the answer to that is yes or no. Well, why do I say that? Well, it's not a problem if you have a plan. If you don't have a plan, then obviously it's a major concern for you. But the reality is, for our clients, we do have a plan for them. So at the end of the day, we want to make sure that the clients understand what the plan is, how we're going to implement it, and when is the right time to implement it. And we have multiple strategies that we're working with our clients to make sure that we can optimize the amount that they get to keep in their overall circle of wealth. So let's take a look at the economy again. When you're looking at the economy, it's now beginning to look more likely that we're going to have a W-shaped recovery. It's still likely it could be a U, but it's more likely to be a W. Same thing would hold true with the stock market, more likely to be a W recovery. And again, the longer we stay shut down, the more severe that recovery will be. You don't have to talk to too many economists to get that conclusion. So for us, this is not a problem if we have a plan. And again, we do for our clients. Now, if we look at the stock market, on September 2nd, we hit a high of 3580 on the S&P 500. Okay, well, that's pretty good because it really kind of bounced higher than it was at the beginning of the year. But over the last 2 weeks, we've had a bit of a downturn. So as of yesterday, we were down 9.6%. So if you're thinking about the plan, the strategies that we have in place, ultimately, we're looking to get into the blue zone here, which would mean that the stock market would have to retrace about 16.2%. And that would be a really sweet time to be able to implement many of the strategies that are already set up, but we haven't pulled the trigger on yet. So when it comes to the stock market, when it comes to whether people should be worried, no, don't worry. We've got everything set up to be able to activate the different opportunities that are out there. You know, going back to the bolts, we have a strategy. It's not just that picture with a bunch of bolts all over the place. It can actually be built into a strategy, and that's what we have for you. So looking at the strategy playbook again, strategy 1, active management, reallocating sectors. And that is what our portfolio managers are doing today. So that is a constant run for them. You look at strategy number 2, Roth conversions. Well, I want to make a couple mentions on the Roth conversions. First of all, if we have that downturn that we expect, we would want to implement the Roth conversion at that time. But let's assume that the Congress and the House, they decide to get with the Senate and ultimately come up with a deal. Well, if that happens, what we would expect to see the market do would take a bounce right back up again. Why is that? Well, because the last three that we've done, that has been the mode of operation with the stock market. So what if the market continued to move forward throughout the rest of the year? Do we still do a Roth conversion? Well, the answer to that is yes. Because ultimately, we all have a plan to get ourselves in a position where we minimize our long-term taxes. If Trump stays in office, well, we'll probably have several years of conversions we can do at this low level. If Biden gets in, well, we are already planning that the taxes will be going up. So if that happens, we certainly want to get the Roth conversion done regardless of whether we have a dip, because we want to get that money tax-free for our clients. So the Roth conversion is going to happen this year regardless. It's just a question of when's the opportunity. So we'll be watching that. The next strategy 3, draw and heal. This strategy is done with life insurance or home equity lines, or if you just have cash that you have that you can access to allow you to turn off any kind of money that's coming out of the market. And we've already implemented this program for many, many of our clients. Now, the question is, are we going to be paying that back right now? Again, it depends on if this market bounces back up. If it starts bouncing back up because we got another agreement with the government officials to get the stimulus package going, then we'll probably do that in the next month or so. If it continues to come down, we might very well hold off paying back those accounts because, again, we don't want to be drawing money out of the market while the market is going down. It just accentuates the problem. So we're constantly watching that to determine when is the right time for you, and we will certainly let you know. The next one, strategy 4, reallocating risk up. Again, that's only going to come on a dip. And same thing with strategy 5, buying low. That will come on a dip. So you may say, well, tell me more about the strategies. Well, what I'm going to do is I'm going to direct you to our YouTube channel. So Daniel Krug and Associates YouTube. If you go there, you're going to see all the different webinars that we've done for our clients. And keep in mind that you can either watch the full view, 20, 30, 40 minutes of the whole segment, or we have set it up to where you can look at specific sections of each one of those videos. So if you really want to focus on the strategies, you can go in there, look at strictly how we presented the strategies to see exactly how they work for you. For most of you, it would just be a refresher, but it allows you to be able to see what's really going on relative to your overall strategy. That being said, we're getting to the questions and answers. So I'm going to go ahead and bring Rocky back on.
Okay. One of the comments we received was on the FDA stating that they would approve vaccines that are only 50% effective. So I didn't know if you had any comment on that. Or
Well, you know what? I don't have a whole lot that I can kind of interject on that. I personally, I think I've had a vaccine other than when I was a kid. I think I've had the flu vaccine one time. Other than that, I just try to stay healthy and do things as naturally as possible. So I can't really comment on the vaccine and how effective it's going to be, but time will certainly prove that out.
Right, and you really won't know the effective rate until you start using it and getting some data back. So that's information.
Yeah, and that's interesting you say that, Rocky, because all the vaccines that are out there, no one truly knows how they're going to work until someone's been using them for a while. So it's been that way since the beginning of time. It's no different in this one. But we'll just have to wait and see how it works out. I'll probably be one of the 50% that don't get the vaccine, but that doesn't mean that it's a good or a bad thing. It's just my personal opinion of what I want to do for myself. I just believe, keep yourself healthy, work out, eat right, watch our weight, make sure that we're not eating a lot of junk food. If we do that, we're going to stay healthier. And that's probably the one thing that can keep us healthy from the virus more than anything else out there, other than obviously, social distancing and the other things that are being done. Well, there you have it from my mouth. That's for what it's worth.
Okay. One other thing I think we could touch on that we didn't in this presentation is there's always questions around income. Where do I get my income from? And we're in a low interest rate environment. So, you talked about dividend stocks being priced fairly low. I mean, that sounds like a buying opportunity and a way to generate income with the opportunity for those stock values to rise while paying you dividends. So just kind of recap that again.
Yeah, so I think that's a very good point, and something that the money managers have been looking at is, all right, where is the right buying opportunity for those companies that are healthy companies? And they are actually buying into some of those as we speak. So it is part of the overall plan. Now, as a whole, do we buy dividend stocks just to get the dividends? Well, we like the returns. There's no doubt about that as far as the dividend return. But we do kind of want to be selective as to what type of account do we actually put those dividends in. Because from a tax mitigation standpoint, most of your dividends are going to be ordinary income. Well, we kind of like capital gains more because you pay less tax on capital gains than you do on ordinary income. And at the end of the day, it's not how much you make, it's how much you keep. And that's the area that we're focused on the most. So that's kind of our direction. We do see it going on right now as far as purchasing these high quality dividend stocks in some of the portfolios today, though.
Well, that's it for questions. And if we could flip back onto the presentation, we can kind of wrap things up here for people. I want to thank everybody for being on. We enjoyed today's presentation. I want to remind you there's no need to worry. You take care of your family and we will take care of you. So we're ready for 2020, the election and beyond. So everybody have a good day today and we will see you soon. Bye.
All right, bye-bye.